Rama Mohan Rao Amara, the MD and CEO at SBI Cards, joining in the show next. Mr. Rao, great to have you on the show. Your first quarter profits, they've declined, and the NII, as well as we understand, has come under pressure. All the profits have actually improved on a sequential basis. What explains this decline in profitability?
So profitability-wise, if we start from the gross income, we on a year-on-year basis, it's a 12% increase. And sequential terms as compared to last quarter, we were holding the ground despite being impacted by the second wave, which did impact the spends on the cards. Then again, the cost of funds, it continues to be a good story where we continue to record improvement in the cost of the funds. Operating costs, in as much as our sourcing during the quarter is higher as compared to the first quarter in last year, operating costs are slightly elevated. But overall, if you look at earnings before credit cost, which is the core operating performance, we recorded improvement both quarter on quarter and year on year. Barring the kind of elevated credit cost, which again is a function of second wave impacting most part of the first quarter, credit costs slightly they are elevated. But even despite the elevated credit cost, the PATs is at a very satisfactory level, 305 crores, which is like a 74% improvement sequentially. 23% of course year-on-year kind of decrease, leaving a return on average assets of 4.5%. So in the backdrop of very aggressive second wave, when we look at the profitability and overall business metrics, we believe we delivered a fairly strong performance.
So what has led to this delinquency? Is it one time? Will this be in habit? Because the challenge with the retail credit card and the delinquencies is that when it starts, it becomes an habit.
I think we have to look at the problem in two parts. One is a known problem, which is like a RBI restructured portfolio. Another is like whether on a quarter-on-quarter basis, whether we are adding to the stress. So RBI is a known problem, and that is the reason we have always been prudent in terms of provisioning. Providing at almost like a GNPA level kind of provisioning for a 30-day delinquency, and 80% kind of provision coverage once they turn 90 plus. That means once they become NPA. So this we have seen, and this is already a stressed portfolio. The second wave obviously impacted our ability in terms of resolving even a small percentage out of this portfolio. So whatever RBRE was outstanding as on March, which have already become NPA as on March 31st, they have flown into charge-off. But the new vintage, because we did make a lot of changes to the risk filters, it was holding forth, and its behavior is uniform. Is a kind of business as usual kind. It is not adding further stress. Overall, provisioning wise, we have always been conservative. We carried a management overlay of around 258 crores. So I think the way to look at is, despite being impacted by second wave, how much we are worse off as compared to previous quarter. Actually, in sequential terms, we improved marginally. So, as I said earlier, despite elevated credit costs, because of the robust earnings, we did make a decent return on average asset.
So how do you see Q2 moving? Because as we are emerging from the concerns of the second wave, there's also a fear that the third wave could kick in. So how do you see delinquencies and provisioning moving in Q2?
One way to look at this RBRE portfolio is, in the earlier interactions also, we made it very clear that it will be a downward trajectory. As the payments come and as some of it gets charged out, the portfolio will come down gradually over a period of time, which is evident from a kind of decrease in the RBRE composition by 2 percentage points. It came down from 8% as on March to 6% as on June 2021. So it will maintain that downward trajectory as we resolve and as we seek more payments out of this portfolio. With that, along with the journey, the credit cost can also be expected to reasonably follow the same kind of trajectory, presuming that the external environment again doesn't become adverse. And our collection efficiency, as on date, of course, it has come back to BAU, particularly in the month of July. It is almost as good as a kind of efficiency what we have seen in April. Recovery will be taking some more time. So in a couple of months' time, we expect the recovery efficiency to come back. So I can only say the wave 2 has delayed our downward journey in terms of credit costs, but we are surely aiming for a kind of reduction in the credit cost over a period of time.
All right. Well, good morning, sir. Let's talk about customer behavior. How has it been in terms of credit card spends and also especially, of course, spending between discretionary and non-discretionary? Because, of course, the quarter gone by once again saw a repeat of what we saw in Q1. We had the second wave, so I'm sure it's hampered quite a bit of spending that customers do indulge in otherwise. So what were the trends that you saw there?
During the second wave, I think customer behavior was no different from what we have seen first quarter of last year, particularly where they tend to postpone the discretionary expenses while the non-discretionary will still be there. And then again, a trait in terms of where customers were effortlessly migrating to online channels for their spends. It again came back in the same way, very strong way. So discretionary spends have come down as expected. Non-discretionary was holding forth, both in percentage terms it has improved, and it was also in absolute terms it was more or less same like last quarter. Particularly among the discretionary, one item seems to be an aberration where people actually were very comfortable ordering for apparel online. Earlier, POS used to dominate that segment, but we could see a kind of migration of the people and people being very comfortable ordering apparel, even though it is slightly a kind of discretionary item. Other discretionary items like consumer durables, travel, tourism, these continue to be impacted. In fact, on a quarter-on-quarter basis, we saw a kind of dip of 55% in travel, particularly compared to March quarter. And discretionary spends, we saw a reduction of around 21%. But we have also seen a behavior where once things open up, discretionary spends do come back very strongly. In fact, the last year behavior, when we see, we were the first ones to come back to pre-COVID levels in October itself, whereas industry could catch up with the pre-COVID levels in November. So we expect a similar kind of behavior. And another way to look at is when we look at the overall spends, particularly the credit card spends during the first quarter, they are much better than what we have seen between April to September of last year. That means the impact is not that much like what we have felt during a complete lockdown last year. So we are very confident because of the impending festive season and a kind of vaccination drive that is on way, where already more than 40 crore people are already covered through vaccination. And hoping that actually there is no third wave, I think things are looking better and spends will come back strongly in the coming days.
You know, I'm just looking at your return ratios, and I noticed that the return on assets is around 4.5%, but the return on equities is a little over 18.7%. Now, not many businesses, of course, report an ROE of more than 18%, and that too, or rather more importantly, in troubled times. So what's the sustainable ROE and ROE for SBI Cards?
If you look at the kind of composition of interest income or contribution of interest income versus non-interest income, particularly during the first quarter of last year, interest income was more dominant, particularly because of a moratorium where the people continued to revolve and there was no obligation to pay during the moratorium, which elevated the interest earnings. But at the same time, we were barred from charging any late payment fee, etc. So obviously we lost on the non-interest income. But first quarter of current year, obviously, NEA has also improved slightly on a year-on-year basis, which increased the interest earnings. But the non-interest income, which is essentially by way of some late payment fee or otherwise the processing fee, what we levy while giving various loans, etc., has come back strongly. And as I said, like spends, retail spends, marginally, they came down hardly by 9% as compared to previous quarter. And they are much better than year-on-year first quarter of last year. Almost they grew by 63%. That means like with the increased spends, you also get interchange, you also get associated business development incentives given by the networks. So on a steady state kind of scenario, you can expect kind of interest income to contribute 50% and the non-interest income to contribute 50%. With a EBCC of almost like a pre-tax basis. I'm talking about earnings before credit cost, anywhere around 11 to 12% in a normal steady state scenario, where the credit costs are also around 5-6%. So it leaves a healthy 5 to 5.5% ROA. So that was the reason why we were able to come back very strongly from the previous quarter, where the ROA was around 2.5%. Now we could come back to 4.5%. This is sustainable because consumer behavior is also changing. We are also leveraging our learnings as to how do we engage with the customer, how do we sustain the spends, and what kind of offerings we have to make. It's a continuous journey for us. We are confident this will be this track record profitability can be sustained.
Right. So last question here, what is the kind of growth in profits that one can expect for the full year, and how do you expect the asset quality to shape up going forward?
Yeah. Despite the kind of short-term headwinds, kind of adverse situation that is prevailing, given the low penetration of the credit card in the industry and favorable demographic trends that are there, we are reasonably confident about the medium-term and long-term growth prospects of the industry, particularly given the kind of incentives being given by the government and regulatory regimes in terms of promoting the digital payments. I think we are very optimistic about the prospects. Even, the kind of disruption that is happening in the digital payment system, even though it appears like this may be a potential competition for a credit card industry, we strongly believe actually that can provide and augment our new customer acquisition. So we are very sanguine and we are very optimistic. Of course, there should not be any third wave. Barring that, we are very confident that we are on a sustainable, profitable growth record.
Okay, Mr. Rao, great to have you on the show. We'll take a very quick break, come right back. Lots more lined up on the other side.